Many of us may be unaware, but the repo rate is a major component that influences many of our purchasing decisions, particularly by influencing the cost of borrowing. When the repo rate increases, it impacts loans for cars, houses, education, personal or business loans, credit cards, and mortgages. So, what is a repo rate? And how does it affect us? Let us understand that now. The majority of what we do and what we get depends on the decisions made by the RBI as we try to survive this economy through savings and investments. The adjustment in repo rates is one of the important decisions the RBI is making right now. It is one of the everyday jargons you would hear today. Let's attempt to comprehend how the average person is impacted by RBI's modifications to the repo rate and reverse repo rate. First though, what is the repo rate? Repo rates, according to the RBI, are money market instruments that enable collateralized short-term borrowing and lending through sale purchase transactions in debt securities. Repo rate, in other words, is the cost for banks to borrow money from the RBI. To combat inflation, a nation's central bank, which in the case of India is the RBI, raises the repo rate. Banks are discouraged from borrowing from the RBI when the repo rate is raised. The economy's decreased money supply aids in the management of inflation. Now you must be wondering how it affects us. A little increase in the repo rate increases the cost of borrowing from commercial banks. The rate increase has an impact on a variety of loans, including those for cars, homes, education, personal or business loans, credit cards, and mortgages. The average person is deterred from making pointless purchases as borrowing costs rise, which lowers the demand for products and services. This starts a domino effect that lowers prices and, as a result, inflation. The repo rate serves as a stimulant in this simple game of supply and demand. When obtaining company financing becomes expensive, companies cut or stop employing, which results in unemployment. The auto sector is impacted by consumers' hesitation to purchase any luxury goods, including automobiles. The move by the RBI to raise interest rates might have an effect on the real estate sector, which had seen a healthy uptick in sales since financing was so affordable. The trust of potential home buyers would be undermined when banks' interest rates rise, pushing up the EMIs for current borrowers. The entire purchase cost for home buyers would be affected by the increase in loan rates, which might also somewhat slow down residential sales. This increase warns prospective buyers that the historically low interest rate environment, which has been a significant factor in house sales nationwide since the epidemic started, is about to come to an end. The burden on the residential sector, which performed quite well in the previous quarter, will increase due to rising interest rates and inflationary tendencies in the main raw materials used in building, such as cement, steel, labor costs, etc. On 8th June, the 6-member Monetary Policy Committee, MPC, which is led by RBI Governor Shaktikanta Das, has increased the repo rate by 50 basis points to 4.90%. The RBI will resort to raising the repo rate once again in a few months if inflation persists in rising despite the recent modifications to it.